Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Well, Eric, we constantly get calls, folks that are wanting to compare annuity rates and bank rates.
Oh, that's the one thing that comes out of their mouth almost immediately. Hey, what's your best rate? And I'm like, on what? Because they assume, I think, there's just one type of annuity.
Right. And if there's some standard rate out there.
And most of them have been used to calling the banks and saying, hey, what's your best rate,
Yes.
on your 5 years,
Yeah.
And when they're calling us, and that's where I usually have to break it back down. All right, let's back up and let's do a little bit of talking about what you're looking to accomplish. And for folks that are looking for rates, usually that's where I start with a certain type of annuity. And it's usually the multi-year guarantee annuity.
And when you tell folks that, that it's maybe 6 times better than what they're getting at the bank,
they get all excited.
There's a certain level of excitement. Yes. But then they,
in the back into the number,
let the air out a little bit when we tell them that.
It's about 3%.
You do the math, it's around 3%. Yeah.
And there we're looking at the multi-year guaranteed annuity types. You're usually topping out, if you're looking at a 5-year guarantee, where you can get 3%, 3% each year for 5 years.
And these are fixed annuities that we're talking about here. And there's other types of fixed annuities that have different, ways they credit that interest. Well, teaser rates.
And that's the funny thing. When most people, when you say the word fixed, they're assuming that you're going to get that multi-year guarantee
on every fixed annuity.
Exactly.
But you don't.
No. On a base fixed annuity, the insurance company is going to state what the fixed rate is for that year. And then the next year, they're going to state what the fixed rate is again for that year. So it's really getting a market rate each year.
Yes.
So it's going to be subject to change based off what the insurance company determines. Now, there's usually a minimum state.
Right.
So there is a floor in there. It won't go below the floor.
And I know, but but sometimes that teaser rate, it's that's what we call it. It's a little bonus, and you get maybe that 5% the first year, 4%, and you're led to believe sometimes that you could get that every year or even exceed it. But the truth of the matter is, you're not likely to. That declared rate is going to be considerably lower on the following years. And sometimes you're better off to just take the multi-year guarantee annuity, know what you're going to get, rather than letting the insurance company control that.
Yeah, if you want the fixed rate and you're going to take the uncertainty, you have to really take a little bit of a projected look forward as to where you think rates are going.
Right.
Right now I would say the multi-year guarantees are probably, for those people who are looking for a guarantee, that's the best way to go.
It really is. And for those folks that can accept just a little bit of volatility in the amount of interest they earn, knowing that they'll never go backwards, the fixed indexed annuity has become extremely popular because it uses an objective benchmark instead of just the subjectiveness of the company declaring a rate. It will take a benchmark like the S&P 500 or the Dow or something of that nature and say, hey, as long as this is going up, you're going to get some percentage of what it goes up. And so there's a probability with fixed indexed annuities, when you look at them and do a little, back testing, that you're maybe going to get more in that 4 to 6% range, possibly.
Exactly. Now, we should always toss out there that there's a chance you're going to get zero. That's what that index is.
It's an average that you're going after.
But that that you have basically no investment risk.
Right.
So it's a low risk annuity. You're going to take the investment risk off the table. And there's different pieces out there, and depending on what you're looking to achieve, there's even fixed indexed annuities out there that have a floor of 1%.
That's pretty cool, Eric.
It's very cool. Can you think of the idea of getting 1% as the guarantee every year?
A bad year is only 1%.
Exactly. You're doing the same as
what the bank's
doing. Or you have the opportunity to get what the index gives you and have the opportunity to get even better. So
So it's kind of like have your cake and eat it too.
That's about the best you can do.
Annuity.
Exactly.
Right. So now when we start talking about annuities compared to banks, we should talk about the backing and the safety of those products, because folks, the banking instruments are FDIC.
Yes.
FDIC protected. It's
Backing by
the highest guarantees you can get. Again, I know there's always the controversy as to, how strong is our federal government, with all of our national debt and everything, but it still is recognized throughout the world as the strongest financial system, on earth, literally.
Right. And then with the annuities, you've got the first and foremost, the claims paying ability of the insurance company.
Right.
Look at the ratings, look at the financial strength. You know that by statutory compliance that they're going to hold a dollar in reserve for every dollar they have out there in liability.
Exactly.
And many of them have even
They have surplus.
Yeah,
surplus reserves.
$1.08, $1.10, $1.20 on reserve for every dollar they have out there.
Right.
That's the first and foremost thing.
And these are going to be your A-rated, your A-plus rated companies that you use these third-party rating services. Many of these companies, Eric, have been in business for 100-plus years.
Yeah, and then that's what the beautiful thing is, that you've got things that are highly reserved, companies that I've never seen in my lifetime, and anything B plus or higher ever go out of business in the insurance side. Now, I can just honestly say that's what I have found in my research. I'm not saying it won't ever happen, but that's what you have to look at. And if you're going to compare that to the banks, unfortunately, I've seen too many times where you remember the savings and loan crisis.
Sure.
Because the amount of leverage that banks have, it's not nearly as highly reserved.
Well, with the fractional banking system, they're more prone to bank failure here and there. But they are propped up by FDIC.
Exactly.
So,
but that's where the backing of the government.
Loses.
So we're not trying to compare what the insurance companies have to the banks, because the banks have better.
Yes.
But you do know that from a statutory statement, they've got a lot more reserves.
There's a lot of safety built into annuities.
Exactly.
Let's talk about taxation, because there's a big difference.
Yes, there is. With annuities, you have tax deferral.
Yes.
So until you take the full withdrawal, as long as it's sitting there, it's growing, it's going to continue to grow tax deferred. Now, I know you're a fond, you like the triple compounding aspect.
Yes. It's very unique, only with, annuity products like
Come on. I can get compounding in my bank instruments.
You can't get triple compounding.
What's triple compounding?
Because you're going to earn interest on your money. You're going to earn interest on your interest, and you're going to earn interest on your interest earnings. So, when you start putting it all together, that you don't have to pay tax and pull your interest out to pay tax on it every year. Not pull your interest out, but pay tax on your interest. You actually get to earn interest on that interest, and then that earns interest, and you earn interest on your interest. So
you do have to pay tax when you finally do withdraw your dollars, but as long as it's in deferral, the annuity is going to get triple compounded.
Exactly. It adds up over time.
Your bank instruments that you're going to get a 1099 for. So if you made a nickel this month,
you're going to pay your tax.
Your penny's
2 cents to Uncle
Sam's.
so
you're going to actually have to pay that every year. So now, there is one significant difference when it comes to penalties and surrenders. Annuities do have surrender penalties.
Yes, they do.
And some of them can be quite stiff. I mean, I've seen 10%, and especially on these multi-year guarantees where you're going to get that fixed return. If you need to go in there and get something early, it's a good chance you're going to pay a 10% penalty. Right.
So there's going to be a higher penalty because insurance companies have to know that money that's given to them for 5 years can stay with them for 5 years because of the way that they place it in investment grade securities and bonds and that type of thing. Where at the bank, you're typically going to have some type of a penalty, but it's going to be pretty small. You have to give a little of your interest back.
Give your interest back. So,
get back a year's worth of
interest. Unfortunately, they're not paying anything, so the penalties
don't amount to much.
Right.
And so I think the key to that, as always, Eric, we say is proper planning. You just don't put money
from a liquidity standpoint. You want to make sure that these are dollars in the annuity side that can stay there for the least of maturity.
Right. And there are some liquidity features. Many times you can take out 10% annually, or you can take the interest out, or something of that nature. So it's not without any liquidity
as long as you plan for it. It's knowing what's available to you.
Right. Now, creditor protection.
This is what do you mean creditor? what the heck is creditor protection? Is that like some kind of LifeLock thing or something? What are they protecting me from?
Well, I think that we live in a very litigious society, and
no, I'm going to sue you, Dick.
No, you can't. I have my money in annuities. But that is a great thing, folks. That state by state, life insurance and annuities are really considered a form of life insurance. They do have a lot of creditor protections that you really don't get from bank instruments. So
I can't come in and put a lien on your annuity?
Exactly. You cannot get to my money. So don't even think about it. Boy, this is a big one here, though. Lifetime income. That's something that you don't get from a bank.
You can't get that from the bank?
When you run out of money,
They stop paying you when you run out of money? That's not fair.
Well, it's a good plan B, because a lot of these annuities, as they grow, and some of them have riders, you can turn on a lifetime guarantee.
Right. Well, and every annuity has the ability to be annuitized.
Yes, it does.
So you can turn any annuity into lifetime income. Mm-hmm. Obviously, it's going to be based off your life expectancy, so we can't guarantee it's going to be the highest, just give me exactly what I want every year. It's going to be based off a realistic number.
Yes.
But you can't get that from a bank.
No, you cannot. No.
Yeah. What a deal.
Well, it's a very nice additional aspect of annuities. Won't always be used, but it's there if you need it. And, Eric, we've talked a lot about a lot of different things, but just kind of coming back to annuity rates versus bank rates. I mean, don't you think that it's a fair comparison that people should be making?
Oh, definitely. You definitely need to look at both sides of the aisle before you decide to go one way or the other.
I agree.